Welcome back to the ABCs of ERP and beyond, where we dive deep into the essentials of enterprise resource planning systems and their impact on business operations. And in today's episode, we are zoning in on an aspect of financial management within ERP systems, and it's the tracking of cost of goods sold. Accurate COGS calculation is fundamental for any business to understand its profit and operational efficiency. And as ever, I'm joined with my esteemed co-host, Nirav Shah.
Hey Peter, how are you?
Very well, thank you. How are you?
Excellent, not too bad. Rearranged the studio today, aka my office. So I'm excited about the new layout. Hope we get some positive feedback from our viewers here. But baby steps. I'm not, an interior designer, but I have a keen eye in decoration. So.
And what did that decoration involve 5 minutes ago?
Yeah, I moved a few things from that corner and I put that picture there. So I think that was a perfect spot.
Yep, that's brilliant. Don't change careers just yet.
Okay, I won't. Thanks for that feedback. Needed that.
Yep.
I need that validation sometimes, so appreciate it.
Yeah, the career you're in right now is working fine.
Just keep it there.
Yeah. Keep interior design to something like contained in your own house, and then
I'll start. Why don't I start? I come over to your place. We'll start there, and we'll just do a bunch of design stuff, and validate all my designs I have in my head.
Yeah, that means just dumping pictures in the corner of rooms. Then fine.
I'm doing good. Excited about this topic. Excited about this could sometimes feel like a dry topic, cost of goods sold, but this is so important. So many companies get this wrong because they don't make it real time. They're always scrambling after the fact, and trying to piece together, the numbers on what, were they profitable? Were they not profitable? How profitable were they? So we kind of came up with this particular episode because it's geared to that customer, I think that, or that user that's like probably on QuickBooks, maybe, still doing stuff on Excel where they don't, have a good handle on all their costs. They know that there's money in the bank every month and they're able to pay their employees and stuff like that. But, they just, are maybe blind to the fact that vendors are increasing costs or their labor force is becoming a little bit more expensive. But they're selling product at the end of the day. So, that is, this is an important area where if it's not reviewed and it's not properly managed, these costs could spiral out of control and come back and really bite them in the butt, and almost like from a standpoint where they're blindsided, and you want to avoid blind sides, any type of blind spots in your business process. This is one area that should really be thoroughly investigated to ensure it's accurate month over month, sale over sale.
And cost of goods sold, it is a financial accounting term. It's not specific to ERP. So what is cost of goods sold?
Yeah, it's a great question. It's used to track your business expenses related to your sellable items or your sellable services. There's direct costs related to that, essentially. Not too many indirect costs go into that calculation, but you're talking about, if you're talking about material and product, it's raw materials, it's direct labor, it's something that's actually you're touching the product, the end product that's being sold to the customer, or things that are going into that end product that's being sold to the customer. We call finished goods commonly in the manufacturing and distribution space. And I know there's some other miscellaneous factory costs. We call it MRO type items potentially. Could be oils, could be screws, could be, corrugate packaging and stuff like that. That's directly related to the material. Some overhead at some point. So you want to capture, maybe you have a predetermined overhead rate for the warehouse. And that is essentially excuse me, all of the costs associated to run the warehouse, which is the lights, which is the electricity that's managing the machines, powering the machines. It's the employees who are, they're sweeping the floor, on the receiving place. What do those pallets cost you, and stuff like that. There's this indirect cost. There's this predetermined overhead rate calculation that cost accountants generally do, and they'll include that amount on like every time a product is produced or every time a product is received or whatever that is, right? So you get an overall good view of what are my costs associated to sale, cost of goods sold. Exactly how it's defined and said is really the definition is about what you're selling, what is the cost of that good, essentially.
And
So, trying to get to the bottom of that.
yeah, and also there's some things that's not all of the cost of the business. It's just purely the direct costs that goes into the actual goods. So there's a few things that it wouldn't include: marketing costs, utilities, rent of the warehouse,
Right.
insurance, electricity of your customer service office.
Exactly.
So it's anything that's directly attributed to the goods.
Yeah, a golf round is typically not associated to the cost of goods sold. It's associated to SG&A expenses. That's what I say. If it's selling goods administration, right? If it's what we call in the net, the income statement, um, it's net income, other expenses, essentially. Those are not included. Those are kind of one-time expenses. Let's say you had a catastrophe and you had a big cleanup that you had to do in your building, whether that's warehouse related or not. That's not included. That's a separate piece in your profit and loss statement. But it's your sales your salaries, right, for the salespeople, your purchases for stamps or advertisement and stuff like that. That's not included in cost of goods sold calculation. That strictly stays as um, a cost on the income statement, essentially. So you have two elements of that, right? You have your cost of goods sold, which is really your gross profit on the income statement, which is revenue minus cost of goods sold is your gross profit. And then you have your other SG&A expenses there, kind of if we're just talking a very high level. Your SG&A expenses that we just mentioned is going to be marketing, rent, utilities, insurance, automobile expense, office expense. Then you have those, one-off type of expenses that you generally don't occur, which are usually in the other net income or expense section, which is, like I said, a one-time cleanup because you had a catastrophe, a fire in the building, a hurricane came through, you got theft, something happened where, that type of stuff, or you had a very big devaluation of your currency or something like that, right? Then that kind of goes into other expenses. But the final of that is like what we call your net income, right? Which is including the other elements of the income statement. But really, your gross profit is that revenue, direct sales to customers, right? Or whether you're doing projects, that's your recognized revenue to customers, right? Of any work that you've completed. And then you have your cost of goods sold, that's essentially matching the revenue and expenses together. And that's one of the GAAP principles out there, right? When you talk about generally accepted accounting principles, that's a very important um, uh, measurement that has to be adhered to in order to properly have an auditable accounting system, where that system needs to be able to, anytime you do a sale, pick up what that cost of goods sold is and be able to book that together in your financials. So that's kind of what cost of goods sold is and how it works, and kind of what the elements of the income statement look like when as relation to a cost of goods sold section. But there's a lot that goes into it. There's a lot of moving pieces where, if not handled correctly, you could get some pieces in cost of goods sold, and some other pieces could go in salaries, some other pieces could go in, right, another expense bucket, which really should both be rolling up to cost of goods sold. So you have to be careful. You have to set the system up correctly, and to be able to understand what is your true direct cost to sell this item.
Mhm. Is there a set calculation? Like if we were to put this into an equation form, um, what would that look like if we had like costs of goods sold equals what?
Yeah, it's pretty straightforward, right? If you're a distributor, for example, you have beginning inventory, right? This is what I call the periodic. Um, how accountants back into the cost of goods sold when you are on a periodic inventory system. When you're on a periodic inventory system, it's not real time. You're doing counts, cycle counts through the month, for example. So you essentially are backing into what your cost of goods sold number is at the end of the month by calculation using your looking at beginning inventory plus any purchases you made, right? So you're purchasing through the month, you're stocking inventory, you're consuming inventory, using inventory, it's going out the door to customers, minus ending inventory. So you minus the ending inventory part of it, and that gets you your cost of goods sold for that period, which is the cost of goods sold number you book in the financials. And if you're a manufacturer on the other side, you also include a component of labor to it, with some overhead potentially, right? So you may have an average rate that it costs to run a machine that includes machine cost and the labor associated with that, and you include that in your manufacturing, your bill of materials, or your routing, and then that gets rolled up into your cost of goods sold, essentially. Now, the labor portion of that, there's a piece of that when you look at the financial entry, and we'll talk about that a little bit later today, is labor absolutely gets rolled up into the finished good as you are performing the necessary services or processes to get that finished good or subassembly in the proper state, okay, that needs to be in. The other part of that goes on the income statement, so you see what's called labor absorption. That's just an offset to payroll. Really, that's more pure kind of utilization metric that's used on the profit and loss statement itself, but really the cost of it will go to the P&L on the cost of goods sold side ultimately when that item gets sold at some point during the selling process or cycle. But yeah, so it's you got the beginning inventory plus purchases minus ending inventory is pretty much the calculation in a periodic inventory environment. Perpetual inventory environment's a little different. We'll talk about that. And that's really where ERPs shine, is real-time cost of goods sold based on perpetual inventory model, because it keeps your inventory layers accurately stored so it knows which layer of inventory quantity and cost to use and consume in the production process or the selling process, so your cost of goods sold is accurate.
We are now going on to like how does this work for an ERP, but before we get there, essentially we're going to talk about um, how ERP does it. It does it very accurately. It does it in real time. But why is the accuracy of cost of goods sold such an important thing?
Yeah, I mean, like kind we said earlier, it essentially is giving visibility to how efficient you are in selling your goods, right? It's the cost of doing business for you at the end of the day, right? And to me, I think that's probably one of the most important numbers. So obviously, you have margin and profit and all that stuff, right? And there's a lot more smarter accountants than I am that do a bunch of other KPIs and measurements against the income statement, balance sheet, and operational costs and stuff like that. But cost of goods sold to me is like more fundamental. It's a number where you need to manage and understand, very quickly, how, what are vendors charging you more now? Are you getting bad material from vendors? Right? Is labor costs increasing? Are you doing a lot of rework? Right? And just fundamentally, if you just understand that that number is going up and down, you'll be able to make a lot of decisions really quickly, right? Without having to crunch a lot of numbers at the end of the day. Um, it tells you, what's going on economically with the business, and then obviously ultimately leads to accurate profit reporting, margins. Do you need to increase your selling price? Do you decrease it? are you staying price competitive in the market or not, right? All that type of stuff is analysis that you do around it. But I think ultimately it boils down to, do you understand what the cost of doing business is for the products that you sell, right? That's cost of goods sold.
Yeah, it's really interesting because then you can assess this relatively quickly, like almost to the end of the day, of the cost of doing business of that day. So you can, very quickly assess where those costs are coming from. If you're seeing stable revenue, but cost of goods sold is going up, well, then you'll be able to have that multi-layer recording from the ERP to see, right, is this labor? Is it now that my machines are not outputting as much, so I'm consuming more in machine resources, or is it the purchase of raw materials? Has the purchase of raw materials gone up? So these are the kind of things that it can be tracked in other places. Maybe purchasing have their own different types of reporting methods or ways of analyzing purchase, but it also shines a light for the financial overview of the business as well, doesn't it? It starts
Yeah.
to ask questions of where you're seeing these costs tracked, and which particular cost can be identified pretty quickly when you're assessing profitability.
Yeah, absolutely. With all the different moving pieces that you have, warehouse environment, dealing with inventory, it's really important to understand what that cost of goods sold number is, because it gives you a good indication of, you know, inventory is probably one of the biggest numbers on the balance sheet for most customers, right? Work in process could be a big number on the balance sheet for customers. Is how are you buying more at a higher cost, right? Should you be negotiating more with your vendors to get a lower cost? Essentially, is there better other vendors out there that you could buy at lower cost from? Things like that, right? It's such an important metric.
Hmm. Okay, so how can ERP systems, we've got a few points written down here, is how ERP systems can organize this for us and really manage the cost of goods sold. So instead of having this manually written down or held outside of the rest of your system, it's now being managed in your ERP. What do we see ERP doing to manage these?
Now we're getting down to our favorite topics here on the ERP side and how ERP could help here.
Hmm.
Um, a ton. Um, ERPs are designed to keep your data organized, real time costing. We've kind of said that throughout this episode, throughout a bunch of different episodes, right? Um, but it's more keeping yourself real time, keeping those purchase costs accurate, keeping inventory layers accurate based on specific costing methods, right? So if your costing method and the way you report your financials is based off of LIFO, last in first out, or if it's FIFO, first in first out, or if it's standard cost, if it's average cost, these systems are designed to take those costs, purchasing costs that come in, properly store those inventory records as what we call inventory layers in the system with unique identifiers by like entry number, for example. So if you're a FIFO, right, electronically, anytime you use that inventory in your production or selling, it knows based on entry number and the different layers that have been open that are available for sale or consumption in your ERP. It picks up that appropriate layer and moves that into your cost of goods sold, right? And that's the important part. You don't have a human thinking about that all the time. You don't have somebody crunching Excel numbers or kind of going through a thousand line Excel sheet saying, okay, what cost should we be taking to associate to the sale, right? That all that algorithm, all the logic is already there in the ERP at the end of the day. So it's important to, from an ERP standpoint, that you're getting this out of the box, right? Making sure the right costs are coming in, being stored and recorded correctly in the database, and then also used and reported on after consumption, invoiced and shipping at the right time against the right orders, right, to get proper reporting through the system. So that alone, I can't tell you how many times I have conversations with customers that are coming off of QuickBooks or that are coming off Excel. That alone saves customers almost 5 to 10 hours a month. 5 to 10 hours a month of reporting on their cost of goods sold number. A full day.
Yeah.
So having an ERP system to manage your cost of goods sold number for you is, I would say, paramount. If your cost of goods sold numbers are so out of whack or fluctuate so much, or you have such a hard time pinpointing what your cost of goods sold is, right? I think you're at the right stage in your business and growth to get into a full ERP system.
It's that role that the ERP plays at so many different places, isn't it? It's the fact that it's largely automated, and this is what they're designed for, aren't they? They're designed for streamlining and automating, a wide range of business processes, but this does include the financial management, inventory tracking, order processing, and therefore cost of goods sold falls within that, doesn't it? The fact that it's automated through the system, and through that automation, you haven't got that manual intervention needed, and therefore the risk of typos, incorrect entries, tired eyes looking at an Excel spreadsheet, it often leads to disaster, doesn't it? But when it's routing through a process flow in an automated fashion like this, you've got that reliable information to be able to report on the profitability.
Yeah, absolutely. And I think AI, predictive modeling, and these different new emerging trends, right, in the ERP world is even going to make that better and more efficient at the end of the day, right? As these AI engines and as your ERP learns more about what your cost of goods sold is, maybe understands more of your vendors, right? It could make suggestions for you, right? It could tell you, hey, this month you usually have a higher cost of goods sold, right? So prepare a little bit more cash potentially early on, right? Things like that. I think there's some very exciting times ahead for ERP and how AI is going to be used. And we've been talking about how AI is going to be sprinkled into everything, especially in the ERP space. So that to me is exciting from the standpoint of if the system knows and you've set the system up accurately, right, it could do some suggestions for you for maybe how to even reduce your cost of goods sold, right? Improve on your bombs, improve on your routings, right? Stuff like that. So I think step one is always to let's get a handle of our cost of goods sold. Let's make it easy. Let's have the system do the work, and let's start making some meaningful, impactful decisions to reduce our cost of business potentially, but still have the proper and same level of quality at the end of the day, but be able to report cost of goods sold accurately month over month.
Mm. Yeah, I'd love to see where AI takes this, because it's going to be able to look at things in its in its entirety at a much deeper level than a human could.
Yeah.
And you might have a particular month where seasonality strikes you, and you do need to build up inventory, or even it might be a particular machine that needs to be switched on and ran, and it knows that it's expensive, or it knows that the capacity is more limited, and it takes that particular production line twice as long, 3 times as long to run that product, and make suggestions based on that. Or imagine if you've got it linked to everything, and you've got your production orders, and your production order is tied to a sales order, and it knows the AP behavior of that customer, and said, look, we suggest that you might want to consider doing this. You might want to consider getting a partial deposit from this customer, because they will affect your AR position. That's cool.
Yeah. Oh yeah, for sure. It's gonna come. I think some of it's already coming in. We're seeing it creep up in different places in ERP, but yeah, I think there's a ton of opportunity there.
Good. So let's just step through then a typical flow that we would see in an ERP. So let's just step through step by step, cost of goods sold. So how does this run through an ERP process?
Yeah, good segue there. It's pretty straightforward and logical when you take a step back and think about it, right? Because you're doing this day to day anyways. These transactions are being done by users in different departments, but the ERP just helps you bring it all together into a more consolidated and single unified view, right? So you can report on that easier and get to numbers faster. So, step one, let's create the purchase order. Right? Purchase order for raw materials, purchase order for sellable goods, whatever that looks like. Purchase order needs to be created. That's a legal fulfilling document for the vendor to basically accepting the terms of that purchase order, whether the cost, what you're buying it at, what the item is, the quantity, delivery date, where they're shipping to, right? Blah 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 blah, all the other stuff, all the other standard T's and C's that's involved in that. Vendor gets the purchase order. They do some work. There's some lead time involved there. And then at some point, that PO, the vendor puts the stuff on a truck, gets sent over to you, a truck, container, freight, air, whatever that looks like, but gets sent over to you and ultimately it comes to your dock. That PO that was originally sent to the vendor is now being ready to be received in. At that point, you get ownership. So a couple different, methodologies to ownership of inventory, FOB shipping point, FOB destination point, right? Depending on which you're using and what's based on the contract. Typically, and most often that I see, ownership doesn't pass to the goods until it hits your receiving dock. So once it hits your receiving dock, you're able to accept this inventory, maybe do some inspection to it, right? Put it into your stocking areas. And when you accept the inventory, right at this point, that inventory should be capitalized. For the most part, gets capitalized, goes on your books, becomes an asset on your balance sheet, essentially, and just sits there as an inventory number until you're ready to go in and consume it, either in manufacturing or sell it to the customer. Okay, so that's the first important point. Then you receive the AP document. The vendor invoices you for that, right? And the vendor invoices you and say, well, hey, the example, sorry, let me go back. The AP document, let's say it was for $10. Receive the inventory for $10, and we're going to capitalize $10 on your balance sheet. Fine, that's all good. So, and we have $10 of inventory sitting on our balance sheet. But then we get the AP invoice that comes in, and the vendor said, whoa, you know what? It really wasn't $10. We're going to bill you $11 actually, because there's a price issue and it didn't get caught on the PO side, so it's going to be $11. Okay, well, we call the vendor. We try to talk them out of giving us we try to talk them through giving us $1 discount, but they say no. They deny us, rejected. So we got to pay the $11. We say, okay, you know what? We'll take the $11 liability. Well, this is the second part. Is okay. Now you're willing to accept that $11 liability. We need to update that inventory that we just put into stock for $10, right? So the ERP will go and find that inventory layer that got booked at whatever date and update that inventory to $11 instead of $10. Okay, using a three-way match function. That's number two. Now inventory is sitting on our books for $11. Okay, on our balance sheet. Now comes the fun part. Is now we're going to use that inventory in production. Maybe there's a production order that calls out for that item that we just received in. Well, as soon as we take that and consume that electronically, kind of right into the production order, well, we incur what's called work in process. Now that $11 that was sitting in inventory got consumed into work in process. So now in inventory, we technically have zero, and our work in process dollars went up to $11. Okay. That's step number three. So you see how that inventory that dollars just flowed to more real-time activity of what's happening in that inventory. Then whatever we consume that inventory for, whether it was a finished good or sub-assembly, and we complete that and we output that production item into stock, and let's say there's no other cost, we have no other labor cost, well, that work in process goes down because we increased finished good inventory, or we increased sub-assembly inventory, and now that cost of that is $11 because of the raw material that we consumed. So now you have this finished good of $11 still on the balance sheet, and now at some point you're going to sell it. You're going to sell and ship that inventory. And when you sell and ship that inventory, right, you're going to pick that inventory, you're going to ship it, put it on a truck, slap a label on it, right? And off it goes to the customer. But what happens financially to that is that automatically there should be a smart system in place, like an ERP system, that knows to take that $11 because now you sold and shipped that specific inventory item that was sitting on your books for $11 should immediately go to cost of goods sold for $11. And let's say you sold it for 20. So now you should see a margin of $9 for that sale without doing any additional work because the system has kept track of those costs at different points in the process for you without having to pull manual Excel spreadsheets, right? Looking at 2-3 different systems to figure out what that cost was because the system is smart enough and intelligent enough, an ERP system, to understand what costs are being picked, which costs are being consumed, and which costs need to be associated ultimately to that revenue against that customer. So that's kind of like typical flow and how it works on the ERP system from a very basic level. There's so many other routes to this, but this gives a good general idea of how cost of goods sold is managed in a full-blown ERP system. Kind of take, for example, Acumatica or Dynamics Business Central.
Well, I think that probably pretty much wraps up today's episode on how ERP systems manage cost of goods sold and why it's so important to track this, have it accurate, and the benefits of ERP. That also gives you that accuracy and also gives you it much quicker in an automated, almost real-time fashion as well. So a big thank you to you, Nirav, for sharing your expertise on this and making these complex concepts a little bit more accessible for the rest of us. So thank you, and thanks to all our listeners joining us on the ABCs of ERP and beyond. Make sure you smash that like button and subscribe and donate and convince people that we should be sponsored by Starbucks.
Yeah.
It will happen one day, I know it.
Yeah.
But until next time, take care, and Nirav, I will catch you on the next one.
Excellent. Thank you.